Stocks have eased as the trade relief fizzles out. The market optimism after the US and China agreed a trade deal seems to be dying down as uncertainty lingers. After Wall Street erased its losses for the year, indexes now look set to open lower. Chris Rosbach is Chief Investment Officer at J. Stern. Chris, do you think worries about trade uncertainty are still weighing on investors' minds?
I think that after the strong backdrop that we started the year with, clearly everything's been upended by the aggressive position that President Trump has been taking on trade. The fact that now it looks like the landing zone is going to be something like 10% tariffs plus additional tariffs for different categories or countries where there's specific goals is very different. So it's not surprising at all to see that also the market has recovered. But ultimately, it's about companies and not markets. And I think there's a lot of attractive valuations that are still out there. So it's good to see the market becoming more rational after having sold off so much. It's also clear that after such a strong rally, there's going to be a moment of digestion. But I think the focus will turn back to the fundamentals. And those so far have looked like they're robust. And we'll see how much they're going to be impacted by the uncertainty that's been caused.
Later, we get a check on the health of the US consumer, with both retail sales data and results from Walmart out today. We have seen lower consumer confidence numbers recently. Will we see that, do you think, reflected in this data?
I think it's possible. The indications that we've had from many US companies that have already reported, because we're clearly towards the end of the reporting season, has actually been quite positive. They've all taken into account the trade issues. They've issued guidance on that basis. And for the most part, it's been really positive. And I think in many cases, that's because the exposure that companies have to imports from China, while it can be significant in some industries, is much lower in others. And the large US companies have ways of mitigating it. So I think that the first order impact, which is what are these tariffs actually going to do, is something that is now looking like it's going to be more moderate even than has been put into the guidance of a lot of these companies. And the second order impact, which is what is it's actually going to do to consumer confidence, and we shouldn't forget corporate confidence, that's what we're about to see. There's been some indications that there's slowdowns. You've referred to, we've seen consumer confidence numbers a bit lower. We've seen the savings rate go up. So US consumers saying we have to be a little bit more cautious. So we may see that in some of these numbers. But so far it's been moderate. And what Walmart has also been saying on April 9, when they gave the investor conference, they've also so far been quite constructive.
We did this week have a surprisingly benign inflation reading. Do you think that makes it a little easier for the Fed to hint at cuts, perhaps?
I think it's possible. The word that we've been dealing with since the recovery from the pandemic is really Goldilocks. We had the pandemic, we had this spike in inflation, we had the normalization of interest rates, which are back to levels that are consistent with the way they've been for a long time. And so Goldilocks is the question. But the problem is, in the fairy tale, Goldilocks, the porridge is just right. In the real economy, it's always too hot or too cold. And that's what the Fed has been having to navigate. I think now with this Goldilocks scenario happening, where growth is still resilient, where inflation is actually coming down, and it hasn't been impacted by the concerns about higher prices from imports, that does give the Fed the full flexibility. I think the fact that President Trump has also backed off and has confirmed effectively, at least for now, that Jay Powell's position is in place and that he's not going to be changing the status of the Fed, as it were, in this critical moment, gives it a lot of firepower. And so I think it can act in the way that it has to offset these macroeconomic and geopolitical uncertainties that we're facing.
We've also seen energy stocks losing ground this morning, Chris, and oil prices falling. The IEA has lowered its demand forecast and it blames trade uncertainty. What do you make of that?
I think that there's a lot going on in oil prices. The big thing, of course, is that U.S. shale is the swing producer. And so that therefore there is an almost unlimited supply of fossil fuels fundamentally that's available when the U.S. shale industry decides to increase or decrease production. So the role of OPEC has become a lot less important. And even though some of those countries produce oil at very low prices, they are still having to look at the global environment for that. So I think it has to be seen from a fundamental perspective, but also from a geopolitical perspective with everything that's going on. It's not really surprising to see that there's a softness in demand with the uncertainties. Something that has happened, and we've seen this in the numbers, is that the trade between the US and China has basically come to a halt. One of the reasons why we're seeing the movement in trade, these negotiations and the tariffs, is because we're right now getting to the point where orders have to be placed for the second half of this year, or the goods simply won't be there. So I think seeing a short-term decline in demand from this uncertainty is something to be expected. But I think overall, the oil prices are going to be set by the supply and demand balance. The demand clearly is a little bit reduced, but supply is there. And so I think moderate oil prices is something we should be looking at.
That was Chris Rosbach of J Stern. Don't forget you can watch more videos on Reuters.com.